Okay, guys, welcome to another lesson. I hope you are all good. Happy Wednesday, I believe it is. This is going to start basic, but then I'm going to show you how you can enter the markets. So this doesn't matter whether you're a beginner, whether you are an advanced trader, or whether you're just a trader that's kind of in the middle looking to get profitable. This is for anyone who is looking to understand just how possible the opportunities are within trading. Now, I know a lot of you that are coming today have seen these candles. Now, just for reference, this is a bullish candle on the left. On the right is a bearish candle. For psychological reasons, because when you go onto a chart for the first time, your TradingView broker or whatever broker you go with will have a green up candle and it'll have a red down candle. Psychologically, I don't like that. I like my candles to be more of a neutral color because I've made a lot of money selling price, and red candles always comes off as negative. The color red is typically quite negative. So I changed that completely. And the color green is always seen as the positive color. When it's red, you have to stop at the traffic lights. When it's green, you can go. And in trading terms, if it's green, it's good. If it's red, it's bad. But there's nothing wrong with the red candles. When you're in drawdown, I get rid of all the redness that's in there. If I lose a trade, yeah, I'm on the red. I'm down. I'm in the red. But I know that I trust the markets. And I understand that I do take small losses from time to time. But the whole change in the color of the candles is a complete game changer. And it was little things like that which completely just make you believe. Okay. So for reference, a bullish candle has to open, it has to create a low, it has to create a high, and then it has to create a close. It obviously varies from where, in terms of where the candles close, how bullish the candle is. And vice versa. When we are bearish, we are opening, but a bearish candle is going to close below what price opened at. Each candle is fractal, which means whether you are bullish or whether you are bearish on a daily time frame or on a 4-hour time frame or on a 1 hour or on a 15-minute or even a 1 minute, even a 5-second chart. Every single candle that is printed will look something like this. It will have, in a bullish format, the exact same parameters that you see now. In a bearish format, it will have the exact same parameters that you see here. Now, what you have to understand is that all of these time frames, from the 5 seconds all the way up to the daily, the only thing that separates them is speed, because price is fractal. So the daily chart moves a lot slower than a 5-second chart, which obviously moves an abundance quicker. So to get the best prices as a trader who wants to make money, you have to be buying price in direction with the daily time frame in an ideal world. And you want to be selling price in direction with the daily time frame in an ideal world. The reason you're utilizing the daily time frame is because the price action is spanned over a 24-hour period. If you're a day trader, we're going to use that time frame. If you're a swing trader, you would use the monthly time frame or the weekly time frame, because you're utilizing it over a few days. If you're looking to get in the charts and you're looking to make money on the day and then come out of your position, or you're just looking for an entry on the day and then manage your position over the next few days, you have to get in at the best place within a bullish frame and a bearish frame on a daily time frame. If you measure from the low all the way to the opening, the 50% marker and below is your discount level. That is where you want to be getting involved in the action. That's why I've just put out a post on social media that you need to be buying below the open. Well, that's because we want to get in at the best price to take advantage of the biggest move in price. And if you want to get involved in sells, you need to be getting involved as high as possible, above 50%, as close to the open or above the open if you can, so that you can take advantage of the biggest moves within a sell market. All that we are doing to look for these opportunities is observing price action on a smaller time frame to see where price could potentially react from. So if we just move over to the chart, and if you try and understand, and this is risk management now, that if you take all of the candles which performed from the whole of August, for example, this is August right here, and this, let's go till sort of the end of, right about here. If we look at this range, this is a daily time frame. Your job is to try and guess which way the daily time frame is going to go. And you're going to utilize the guessing part of it via your analysis of risk management. We don't know which way the daily time frame is going to go every single day by pure facts, but we can utilize our level of understanding within the markets, and we work on the basis of probabilities. But just for reference, let's say you traded on this down candle here, and then let's say you were looking to try and be bullish. Well, you would have got it wrong on this day, and you probably would have taken a loss. So let's say you're down 1%. But if you tried to be bullish every single day after that, from 1, 2, 3, 4, 5, 6, 7, 8 days of price action, maybe you got it wrong in here once and you're down 2%, but the other 7 days worth of price action, as long as you're utilizing good risk reward trades and you're at least looking for a 1 to 2, you could be 14% up. Taking away the 2%, you've got it wrong. You're 12% up. On average, you're about 10% up based on the price action that you've seen here and got it right. Maybe within this area here, it got a little bit confusing because it started to consolidate. So let's say you lost a couple here. Let's say worst case scenario, you're up about 7%. 7% on £1,000 isn't a lot. 7% on £1 million is a lot. 7% on £100,000 is a lot. And don't worry about the capital. The capital is the last thing you need to worry about. You need to worry about getting good at the skill. But your job is to get involved in the daily time frame. Your job is to try and guess the direction based on the probabilities. When we do that, we are looking to utilize a smaller time frame pattern within these areas. And usually when price opens, you are going to get something called manipulation, which is when you get the wick coming lower. And the wick usually comes lower to a certain point. When we are bearish, the wicks usually go higher first. That is manipulation within the markets, and it usually goes towards a certain point. This is where on a smaller time frame, we are trying to utilize a key level on a higher time frame, a point of interest level. So you would wait for price action to travel down to that area, and you would wait to get involved when you see a particular pattern. And if you refer to the lesson that we did the other day, when I spoke to you about the entries you want to be taking, you are looking to utilize any of these entries in here, any of these models on a smaller time frame. Just for reference, if we're looking at a daily time frame, maybe you want to look at a 15-minute or a 5-minute. If you're looking at a weekly time frame, maybe you want to look at a 1 hour or a 4 hour or something like that. But you'll get used to it when it comes to the time frames. But imagine this is the manipulation up here. Price travels down into your key level and then gives you a reaction. Now, these work in, order of probability, in my opinion. A change in the state of delivery is definitely valuable. A change in the state of delivery is where you've got one candle and then you've got a change in the state of delivery because you've got an engulfing candle moving higher, giving that as a valid order block. You've then, on the far right here, got a fair value gap. That is just buying pressure in between these two wicks right here. Again, I've done lessons on fair value gaps. Go back and watch them. Go and have a look at the fair value gaps. That's when you're looking for a fair value gap within higher time frame key level. But the best one you can look for is something called a balanced price range. And that basically is when you have two areas of imbalance which overlap each other. This is your inverse fair value gap, because if you take away all of this price action here, you would have had sell side imbalance. That is because there are only sellers in the market. When price pushes higher and violates this area of imbalance, that is now called an inverse imbalance. So that is no longer valid. But when you get price action create another area of imbalance, overlapping the previous imbalance to the opposite side, that is a very, very strong area of imbalance, and we call it a balanced price range. This alone is enough to look for within higher time frame key levels on smaller time frames. Your higher time frame key level can be your daily time frame. Okay, if we go back and actually look at today's candle, this is all of the price action that we have seen today. Zoom that in. Now, within that piece of price action that you see, okay, sorry about that. Within that price action that you see, we opened here. This is the opening of the candle. And then price came all the way down and made a low, and price has made a high and is currently retracing lower. So is there any possibility that we could have been a part of all of this move up to this area here? Well, just looking at it from the daily time frame, we have swept below this liquidity. We've swept below the previous day's low. But we don't know what we're looking for. We can't look at this on a daily chart, because all you would see is price action moving like this. So this is where we need to utilize the higher time frames. So the smaller time frames, sorry. So if we look at this, okay, this is the opening of the price. We're going to bring it to where it actually should be. Right. Hang on. Let me just do that again. So the opening price was here. And as you can see, price manipulates lower to this level here. Now, because this happened in the New York session, you need to be aware of when volatility is going to come into the market. Okay, this is where we utilize Forex Factory, because today at 1:30 p.m. UK time, we had USD news, meaning there is going to be an injection of volatility at 1:30. You do not need to trade until after this event, because there is going to be volatility in the market. And you can see that beforehand, there was just consolidation in the market. Nothing was really happening. So at 1:30, price travels lower and then starts breaking higher. So we had manipulation coming lower. We swept below this liquidity right here, which we spoke about on the daily time frame. Price came down to this level. Is there anything on the left? This is now what we need to start thinking about. From this bullish range, we need to start looking at what is actually going on. We can see this order block right here. This is an order block or an FU candle. And now we have a higher time frame key level on the 1 hour time frame. We know where we want to be. We're looking for bullish price action, but we need to wait for some sort of move. Now, if you're looking to trade this on a higher time frame and maybe trade this tomorrow or something, here's the good news. We can see the price has already looked to create our inverse level and our imbalance. That is your balanced price range on the 1 hour time frame forming right now. That in itself is an entry. Now, this means you probably won't take advantage of this today, but tomorrow, what is likely to happen? Possibly, and this is now, we're predicting the future, maybe price opens where it is, manipulates lower into this area. There's your entry. Price pushes higher, leaving behind this wick right here. Something like that. You would be below the opening price. You would be at the bottom of the wick in a bullish environment, moving higher. But let's say you didn't take that. Let's say you wanted to get in on this on a smaller time frame. And you can see that when price came down to this level here, it started pushing to the upside. Now, just for reference, let me just replay this. When we're bearish, and this is what you see, you need to be marking out your levels. You've got this area of imbalance right here. That's sell side imbalance. Now, you don't want to sell here because you've got imbalance higher up and you're already very, very low anyway. So we would rather look for buys, and we're also below the opening price. So you would be looking for buys. Now, when you see price action coming into this area, you wait. And when you see price action violating that area of imbalance, just like that, that is now an inverse fair value gap. As you can see, within this piece of price action here, we have created an area of imbalance. There is a balanced price range, which we've spoken about. Your entry can be in here. And your target would be up here. And as you can see, price came right into it and smashed through that target and some. All from the higher time frame key level. And you have been able to utilize where you are in relation to these candles. So if you came here today thinking, oh, he's got the candles up, this is looking pretty basic. Yeah, it is basic, but you know what? The strategy is basic. I'm trying to show this to you in a way that you could teach your children to do this. And what I'm going to do now, I'm just going to kind of delete all this here. Let's look at this and what the future looks like for this at the moment. Because I said earlier, price is fractal. And if you actually look to the left, what can we see? We can see that these daily candles have come into this area of imbalance. But we can also see that we are reacting also from this area as well. So we've also got a balanced price range on the daily time frame that we're currently reacting out of. So we were always looking for buy moves to the upside. The only thing you need to be really looking to target now, because the range has pretty much started, we want to be looking for price to come maybe into this area of imbalance. And then essentially we want to be looking to target this area of liquidity. But every single day, you need to mark out the opening price. And you need to look on the left at where price is likely to mitigate into from the higher time frame or the lower time frame, where price is likely to travel down to, and where price is likely to go to. And your job is to try and predict where it's going to go. And your job is to try and get in at the best possible place. And that is what your daily candle is going to look like. You're just trying to utilize the very best place you can do it. And we're targeting this area here. But this is simple price action. We've not done anything other than just mark out key areas. And we're able to understand what price is doing from this key level right here. The fact that we are creating a balanced price range now, that in itself is enough. You could enter directly in here. That would be a solid entry on a 1 hour time frame. I know that scares a lot of people. And this is scary to think how fast you would grow as traders if you just look for these simple concepts. And obviously there's more to it. There's variables of price action. And I don't want people that are watching this in the future to say, oh, but he's just marked out one that's already happened. Well, I'm talking to you now as if like this is real-time price action. I'm marking you up a setup right now. So that's, that excuse out the window. And let's say this one fails. Well, guess what? You're not going to win every time. We work on probabilities. But this is where you need to understand the whole concept of risk management. Because if you take 10 trades on average, and let's say you take a 2% win, and then let's say you take a -1, and let's say you go on a bit of a losing streak and you take a couple of -1s, and then let's say you get that back with a win, and then maybe another win, and then let's say you get it wrong again, because you're trying to predict where it's going to go every single time. And let's say you take another loss, and then let's say you take a win. How many trades have we got here so far? We've got 1, 2, 3, 4, 5, 6, 7, 8, 9. Let's say you take another win. Well, you've got 1, 2, 3, 4, 5 losses. So your win rate based on the last 10 trades is 50%. And you're going to be down -5%. But because you've won 2% every time, you're up 10%. So your total winnings based on risk management is 5%. And that's when you've only got a 50% win rate. Utilizing the balanced price ranges that we spoke about earlier in the session is going to give you a higher win percentage than the 50%. So don't panic if this fails, or potentially price doesn't come back down to it. Maybe it reacts from this imbalance instead. Don't panic, because you've got, as long as you utilize good risk management, you know that you're going to be successful. And you're looking to base the whole thing on probabilities. And let's say, for example, price does react inside here. Let's say because we've got news tomorrow, we're expecting more volatility at 1:30 UK time, which is 8:30 New York time. Well, let's say by the time we get to tomorrow, we're already in this area here. Well, if price opens round about here and reacts to something that is inside this area of imbalance, well, then we're just going to look for that balanced price range to the downside, and we're going to look for sells because we are inside a higher time frame area of imbalance. So we're just utilizing what's happening. And if we keep getting bullish moves targeting that liquidity from this daily balanced price range, then so be it. Then so be it. But at the moment, we need to just mark out the areas which are favorable to us. And we're working out of this daily area. We could target this liquidity, but let's take price to this imbalance and see what happens. Hopefully you found this insightful. And if you have come here as someone that is looking to learn how to trade, or someone that is coming here as a bit of a rookie in the industry that's just struggled to try and understand the simplicity of this whole thing, then hopefully this has helped. Hopefully you found some value with this. And I shall speak to you all very, very soon. Take care.